Hello everyone, welcome to Option Gig. This is your host Vivek Somani, and in today's video I want to go through all the trades that we have done on 1st April 2019. Okay. What you see on the screen is the list of the trades that were executed on 1st April. We'll start one by one. First trade we're going to look at it is the closing trade on Disney. It was a 105 short put that I closed today for 50 cents. So let's look at the history of this particular trade. Now looking at the history of Disney trades, this trade of 105 put was opened on 19th of February. This was the initial opening trade on Disney for a contract expiring on 18th April, 105 put. Initial premium that I had collected was $1.16, and today we closed the trade at 50 cents, hence retaining the remaining amount. So this is our closing trade that we did today. Let's look into how Disney has behaved during the trade duration. So looking at the Disney chart, we opened up the trade when Disney was around here, around $113.50. So even though Disney had made some moves, but right now it is just below $113. So if I had bought the stock, I would have been incurring losses. But in the option trade, the lot of extrinsic value came off from the trade because of passage of time. So theta played in our favor, and hence I was able to close the option trade for profit. Okay. All right. So let's look at the next trade. Next trade that we're going to discuss is the Bank of America. Again, very similar trade. I closed the two contracts of Bank of America that we had 26 short put. I closed it for 24 cents. So now let's look at the history of this particular trade. This is the history of the Bank of America trade. We had opened this trade not too long ago. We opened it on 27th of March. These were 26 short put. We opened up two contracts, one here, one here. We collected 58 cents per trade, and today we closed it down for 24 cents, which is higher than our target of 50%. But the market went higher, so our short put really came into profitable zones, and so we closed the trade. Next one on our line is the new opening trade for Bank of America. Since I had closed the 26 put because Bank of America moved higher, I still want to retain a bullish position in Bank of America. So I opened another trade. Same thing, opened two contracts of Bank of America for 17th May. But today I upped my put contract price from 26 to 27 and collected 43 cents as a premium. Next one I want to look at is a new trade that I opened on Disney. We sold 105 put, but this time it is for 17th May. The reason is I want to still maintain my bullish exposure on Disney. I know they are coming up with some great movies this year, so I want to have a position in Disney. Since I had closed the April contract earlier in the day, I opened up a new contract for 17th May for the next expiration period. Again, for the same strike price, 105 put, and collected almost $108 in premium. Okay. Next one to look at is a closing trade of GLD. This is a strangle we closed. Strangle means we closed 124 call side and 117 on the put side for overall debit of 44 cents per contract. So let's look into the history of the GLD trade. So this is the history of the GLD trade. I had opened up this particular trade on 7th of March and had initially sold it for 98 cents, and today we closed this particular trade on 1st of April for amount of 44 cents. Little higher than 50% because gold moved sharply down today, and hence it came back into our profitable zone area so I thought to close the trade and bank the profit. Let's look at the gold position. Remember, we opened it up on 7th, closed it on 1st. So let's see how gold has moved between then. So we opened it on 7th, which was this over here around 121, and gold went high, but again in the last few days it came back where it started. So it lost a lot of extrinsic value, and hence I was able to close this trade at a profit. The next trade is a rolling trade for covered call on OIH. I hold 200 shares of OIH in my portfolio. I have 200 shares, and earlier I had sold a covered call on OIH. So today I'm just going to roll that covered call from April expiry to May expiry. So rolling means you close down your existing contract, which is 2 contracts closing of 18th April expirations, and then you open up another contract for the next expiration period. So I closing this and I opened up 2 short calls for $17, same strike price, no change in that, just the expiration period was moved from 18th April to 17th May. So this is what we call as rolling the trade onto the next expiration period. So I rolled this off onto the next expiration period and collected 28 cents in that particular trade. So let's look at the OIH trade history. So this was the trade that we had started actually in March. So this is when I had sold off a covered call in March of for the March expiration on 15th March, had initially collected 44 cents as a premium. Then we rolled it from March to April, collected another 37 cents as a premium. And today we rolled the April to May and collected another 28 cents as a premium. So we have collected more than $1 in a premium. Next one that we're going to discuss is the closing trade, a J Lizard closing trade on XHB. It's a little complicated trade because it has got 2 short put contracts at 37 and 1 call spread of 40-41 call spread. So this is the history of XHB over last 60 days. The trades that we are interested in is this. This was the opening trade in which I had sold a call spread, 40-41 call spread, and I had sold 2 contracts of 37 short put. Net premium that I collected was 80 cents. Today I closed the trade in 2 steps. First I closed the call spread at a debit of 14 cents. Then I closed the 2 contracts of 37 short put at 12 cents each. So net debit that I paid for closing this trade is 12 cents for 1 contract, means 24 cents for 2 contracts, and 14 cents for the call spread. So net debit that we paid was 38 cents. We had sold this for 80 cents, so it is just above our profit target of 50%. Next trade we're going to discuss is the Twitter. Again, this is a calendar, means you are rolling it from one expiration period to the next expiration period. Again, like OIH, this is also a covered call trade. I hold 200 shares of Twitter in my account, and I had sold a covered call on Twitter for 18th April expiry, and today we are just rolling it to the next expiry, means I am buying back the 18th April expiration contract and then selling or opening the May contract. The net premium that I collected is $1.59. So this is the history of the Twitter stock. I had sold 33 call, short call on 21st of February, 1 contract here, another contract here. it was for 18th April expiration, and in that process almost an average I collected $1.12. Today I rolled that 18th April contract over to May, and in turn I collected additional $1.59. So within these two trades I have been able to collect $2.71 trades. So if Twitter stays above $33 by 17th May, and it will get called away, but essentially I am selling it at a price of 33 plus the amount of premium that I have collected. So my net or effective sale price would be $35.71. I was assigned Twitter in 2018 at an initial cost of $40, and I have been selling multiple covered calls that today my cost basis is around $31. So I am more than happy to let it go at $35.71, and that is why I put up this trade. So the next trade on our radar is a closing trade for a put spread. I had put up a put spread on the Boeing, symbol BA. The contract was expiring on 21st June, but Boeing moved up higher today and the put spread came into profit, and it was a profit target that I was comfortable with. So I took off the trade by paying a debit of $4.60. So let's look at the history of this particular trade. So this is the history of Boeing trade. I had opened this trade on 15th of March. I opened up a put spread by selling a put at 350 and buying back a put at 300, thus creating a put spread of with $50. Net premium that I gathered by doing this trade was $11.35. Subtract $3.33. The net premium was approximately $8.02. The expiration period was 21st June. The reason I wanted to go out so far was Boeing was recently rocked by the 737 MAX planes crashing, and hence the stock had fallen sharply. I thought it will take some time to recover from it, and I wanted to give myself enough room. But today, within 15 days, Boeing made a nice move up, and hence I was able to take this trade off at $4.60. A little less than our usual profit target of 50%, but I think I'm happy to even get around 42% today within 15 days of the trade. So that's why I took it off. So let's look at how Boeing had behaved between the time when I put a trade on 15th of March till today. Let's go back to the Boeing chart. We are looking at the trade. So this is the area when I put up a trade. So we put up a trade when Boeing was trading just over here around 380. At that time I put up a trade, gave myself enough room. The short put was between this and this, with my assumption was that by 21st June Boeing will go up and stay anywhere over here. So I had enough room, almost $30 room, before the trade could be in danger. Today Boeing made a nice move up over here, and my put spread immediately came into profit, and I was able to take it off for almost $340 net profit, which is equal to 43% of the max profit that was possible. I think I'm happy with this, a good deal to get almost 43% within 15 days of waiting. Alright, so I think that's all the trades that we did today, and hopefully this is helpful for you. Thank you very much for your time. In case if you like what you learned, help me spread the word. Leave your comments on the website or email it to me at optiongig@gmail.com. Thank you very much for your time today.